Support and resistance. A ball hits the floor and bounces. It drops after it hits the ceiling. Support and resistance are like a floor and a ceiling, with prices sandwiched between them. Understanding support and resistance is essential for understanding price trends and chart patterns. Rating their strength helps you decide whether the trend is likely to continue or to reverse. Support is a price level where buying is strong enough to interrupt or reverse a downtrend. When a downtrend hits support, it bounces like a diver who hits the bottom and pushes away from it. Support is represented on a chart by a horizontal or near-horizontal line connecting several bottoms. Resistance is a price level where selling is strong enough to interrupt or reverse an uptrend. When an uptrend hits resistance, it stops or tumbles down like a man who hits his head on a branch while climbing a tree. Resistance is represented on a chart by a horizontal or near-horizontal line connecting several tops. Minor support or resistance causes trends to pause, while major support or resistance causes them to reverse. Traders buy at support and sell at resistance, making their effectiveness a self-fulfilling prophecy. Support and resistance exist because people have memories. Our memories prompt us to buy and sell at certain levels. Buying and selling by crowds of traders creates support and resistance. If traders remember that prices have recently stopped falling and turned up from a certain level, they are likely to buy when prices approach that level again. If traders remember that an uptrend has recently reversed after rising to a certain peak, they tend to sell and go short when prices approach that level again. For example, all major rallies in the stock market from 1966 until 1982 ended whenever the Dow Jones Industrial Average rallied to 950 or 1050. The resistance was so strong that traders named it a graveyard in the sky. Once the bulls rammed the market through that level, it became a major support area. Support and resistance exist because masses of traders feel pain and regret. Traders who hold losing positions feel intense pain. Losers are determined to get out as soon as the market gives them another chance. Traders who missed an opportunity feel regret and also wait for the market to give them a second chance. Feelings of pain and regret are mild in trading ranges where swings are small and losers do not get hurt too badly. Breakouts from trading ranges create intense pain and regret. When the market stays flat for a while, traders get used to buying at the lower edge of the range and shorting at the upper edge. In uptrends, bears who sold short feel pain and bulls feel regret that they did not buy more. Both feel determined to buy if the market gives them a second chance. The pain of bears and regret of bulls make them ready to buy, creating support during reactions in an uptrend. Resistance is an area where bulls feel pain, bears feel regret, and both are ready to sell. When prices break down from a trading range, bulls who bought feel pain, feel trapped, and wait for a rally to let them get out even. Bears regret that they have not shorted more and wait for a rally to give them a second chance to sell short. Bulls' pain and bears' regret create resistance, a ceiling above the market in downtrends. The strength of support and resistance depends on the strength of feelings among masses of traders. A congestion area that has been hit by several trends is like a cratered battlefield. Its defenders have plenty of cover, and an attacking force is likely to slow down. The longer prices stay in a congestion zone, the stronger the emotional commitment of bulls and bears to that area. When prices approach that zone from above, it serves as support. When prices rally into it from below, it acts as resistance. A congestion area can reverse its role and serve as either support or resistance. The strength of every support or resistance zone depends on three factors: its length, its height, and the volume of trading that has taken place in it. You can visualize these factors as the length, the width, and the depth of a congestion zone. The longer a support or resistance area, its length of time or the number of hits it took, the stronger it is. Support and resistance, like good wine, become better with age. A 2-week trading range provides only minimal support or resistance. A 2-month range gives people time to become used to it and creates intermediate support or resistance, while a 2-year range becomes accepted as a standard of value and offers major support or resistance. As support and resistance levels grow old, they gradually become weaker. Losers keep washing out of the markets, replaced by newcomers who do not have the same emotional commitment to old price levels. People who lost money only recently remember full well what happened to them. They are probably still in the market, feeling pain and regret, trying to get even. People who made bad decisions several years ago are probably out of the markets, and their memories matter less. The strength of support and resistance increases each time that area is hit. When traders see that prices have reversed at a certain level, they tend to bet on a reversal the next time prices reach that level. The taller the support and resistance zone, the stronger it is. A tall congestion zone is like a tall fence around a property. A congestion zone whose height equals 1% of current market value, 4 points in the case of the S&P 500 at 400, provides only minor support or resistance. A congestion zone that is 3% tall provides intermediate support or resistance, and a congestion zone that is 7% tall or higher can grind down a major trend. The greater the volume of trading in a support and resistance zone, the stronger it is. High volume in a congestion area shows active involvement by traders, a sign of strong emotional commitment. Low volume shows that traders have little interest in transacting at that level, a sign of weak support or resistance.